Right. Good morning, everyone. It's 9:30, so I think we're going to get started. I am Courtney Berner, the Executive Director of the University of Wisconsin Center for Cooperatives, and I'm really pleased to welcome you to our third webinar in our three-webinar series that we are doing in place of the Directors 101 training that we typically do in person. So it's been fun to deliver this content in a new format, to be able to attract attendees from far outside of Wisconsin, even outside of the United States, and to be able to, again, connect with many of you on the importance of governance during this time. So again, just want to welcome you and do a little bit of housekeeping before we move on to the formal presentation. Kelly, thank you. So today's webinar will run for approximately 60 minutes. As you might have noticed, participants' lines are muted just to keep things quiet on the call, on the webinar. There will be a presentation by my colleague Kelly Maynard, and that will be followed by a live question and answer session. If you have questions that pop up during the presentation, please enter those questions in the question box. There are two. If you look to the right side of your webinar screen, there's a chat box and a Q&A box, and you're welcome to chat in the chat box. But if you have an official question of the presenter, please enter it in the Q&A box. The webinar is being recorded and will be posted on UWCC's website. We have posted the other two already, and this one will be added to that, as well as some additional resources. So today, we are covering the topic of finances, board finances. And again, this is in the context of being a director and Director 101 training. And so I'd like to introduce our speaker for this morning. Kelly Maynard is a cooperative development specialist here at UWCC. She joined the center in 2016. And I actually got to know Kelly long before she was even working in cooperatives, before either of us were working in cooperatives when we moved to Madison. But I got to work with her professionally when she was involved with a farmer-owned cooperative just outside of Madison. And then she joined our center a couple years later. So I will hand over the presentation to Kelly.
Thanks so much for the introduction, Courtney. We have a lot I'm trying to pack in today, so let's get started. Cooperative finance is a huge topic, and today we're going to go a mile wide and an inch deep. We'll review your financial oversight responsibilities as a co-op director, make sure we're all on the same page with definitions of some common terms. We'll talk about the financial reports you should receive and how to read them. We'll talk a little about how cooperative profits can be distributed. And finally, how all those pieces fit together for financial analysis and planning. I hope that this overview gives you a big picture sense of co-op finance and where you might need to spend time learning more. Some of here may be more important to one than another based on sector or ownership type. But I think there should be something for everyone. If you joined us or listened to the first webinar on director responsibilities, these things may look familiar. Acquiring and protecting your co-op's assets and assessing your co-op's performance are two of the 7 responsibilities that we discussed. Also, as a director on the board, you are a fiduciary, which means that you have both a legal and ethical responsibility to act in the best interest of the members in the co-op and to safeguard members' investments to the best of your ability. Fulfilling these responsibilities and providing that financial oversight is arguably one of the most important roles of a co-op director. In the first webinar, we also discussed codes of conduct for directors and the 3 duties that shape this conduct. You might remember that to meet the duty of care as a director, you must stay informed, be competent, exercise good judgment, And the only way to do this is to have knowledge of your co-op's books and other records. As we mentioned then, you are not expected to be a finance expert or a spreadsheet guru, and you absolutely have the right to rely on expert advisors and professionals like accountants. But like you're doing now, it's really important for you to gain basic proficiency in financial vocabulary and reading financial statements so that you can ask good questions. We often hear that finances are the most intimidating part of the business for the most people. And you do want to try and avoid a situation where only one or a few directors understands the financial statements, or you're simply relying on what your general manager or CEO is telling you about the financial picture. Because then you're not able to fully weigh in on really important decisions. Gaining confidence in your ability to will take time if it's newer to you, but that doesn't mean you aren't able to ask good questions for everyone on the board to consider. So what does the annual picture look like? There's a rhythm to many of the financial oversight and planning activities that you do, and many are recurring. If you're brand new to the board of an established co-op, or if your co-op is young and just getting started, it can take a little while to get into. For new directors in established co-ops, hopefully you got some sort of board orientation and a board packet or bundle of information that included some or all of the past year's financial statements. If you didn't, I really encourage you to ask for copies as a reference point. So on an annual cycle, big thing that a board will do is approve a budget. This doesn't sound all that exciting, but really it's aspirational. It's a type of financial forecast or projection where you capture some of the big goals for the year in terms of revenue and other metrics. And it also structures your strategy for what the co-op needs to spend to meet those goals. It's a key document for delegating to management the task of carrying out operations, and is one way that management's performance can be evaluated. The process of developing the budget can vary widely based on size of co-op and number of staff. It might largely be developed by a CEO or general manager, and then getting a final approval by the board. It might be developed by a finance committee or some other subset of the board. And maybe you have a 5-member worker co-op where all members help develop the budget. Develop a set of financial projections that we call a pro forma. And these will look like financial statements, but they aren't statements of what is actually happening. They're statements of what you plan to have happen or hope will happen. And we'll touch on those again later. And part of meeting that responsibility to protect the co-op's assets, you have to develop and maintain a robust accounting system. You usually use some sort of financial software like QuickBooks or other programs. And in that, your chart of accounts is really the skeleton that includes all the categories of revenue, expenses, equity, liability, assets, where numbers and other information are recorded throughout the year. For startups, I highly recommend working with an experienced co-op accountant to set this up. You really want categories to accurately reflect what your co-op does and also be organized in a way that the financial statements they generate tell the clearest story. So moving on in your annual cycle of financial activities, you should be reviewing and approving financial reports at every regular board meeting. This can come to feel really perfunctory. Always ask questions or make observations about what the financial statements are telling you. In addition to those, there'll be some other financial decisions to make inevitably throughout the year. Maybe your co-op is making a large purchase or planning to raise a large sum of money through a capital campaign. Or as we're in now with this global pandemic, there might be some unforeseen event that impacts your operations, and all of these will require some level of decision to be made by the board. Once all the accounts are reconciled at the end of the year, and if which we hope for, the board must decide how to allocate those profits. Also, there'll be an annual report to the membership, should have a financial section. And based on the size of the co-op, you may also do more frequent reporting to your membership on the finances. And lastly, a third-party external audit might be required based on size of your business or certain financial obligations you have. For smaller and newer co-ops, that might be too expensive, and there are a number of ways to do some sort of financial review internally. Part of this is to check for accuracy and that transactions are being recorded properly. And it can be where you discover that something is not working well that requires some new policy or procedure. So what's some of our common vocabulary when talking about equity? Is a word that gets thrown around a lot in co-ops. It's money, broadly, it's money invested in the business. That is, we call it at-risk capital. There's no guarantee it will be paid back. And in the context of a co-op, it's a member owner's ownership stake in the business. We usually say there's some sort of initial equity buy-in, and then you could maybe build additional equity over time through the business you do with the co-op. Full membership rights are often tied to meeting these equity requirements, and their requirements are usually spelled out in some combination of the articles, bylaws, or membership agreement. Also, when a member owner decides to leave the co-op, they often hope to get some portion or all of the equity back. And as a board, you'll have to make decisions about whether the co-op is in a position to do this. Equity is something that will appear on your balance sheet. Debt, term a lot of people know, it's money that you borrow. Can be loans from financial institutions, member loans, loans from other sources. Lenders don't have ownership rights in your co-op. Profit or loss shows up on your income statement. Some co-ops choose to call this plus. And we often think about, reaching a break-even point or generating a profit as the be-all, end-all of the. But this is not really a complete picture of financial health. And we'll talk about this more when we talk about the financial statement. When there is profit, a co-op may choose to retain some for investment, and we call this retained earnings. So a few more terms. We often highlight that a major way in which co-ops are different from other businesses is that they allocate profit to the member owners on the basis of their use, instead of to outside investors or shareholders. This patronage allocation, as we call it, has two parts. The member owner cash refund or dividend, and then allocated equity that goes in an individual member's equity account on the co-op's books. And we'll go through a concrete example of this later. Some portion of the profits might not be allocated to individual members and instead are reinvested back in the co-op. So this is the unallocated equity. If your co-op does business with non-members, your accounting system needs a way to track this. And profits from a non-member business cannot be allocated to members, actually, and one needs to pay tax on them. A per unit retain is not something that all co-ops do, but it can be another way to build equity over time. Additionally, preferred stock is a way of raising equity from an outside investment from non-members. It's not something that all co-ops do. And given the name, the co-op should ever dissolve, get bought out, this type of equity gets paid back before member equity. So as a director, what financial information do you need to be seeing and how often? We usually talk these 3 financial reports. The reports help you understand business activities, monitor profitability, and our decision-making tool. None of the reports is a complete picture of the co-op's financial health. So if you're not getting all 3, you need to ask for all 3. Also, your accounting system should allow you to generate these reports fairly easily, so long as the bookkeeping is up to date. At the board meetings, when you review them, they often will include a comparison to a statement from a previous reporting period, or maybe a comparison to your budget. So we'll go through each one. The balance sheet is a snapshot and a point in time, and it includes a summary of the co-op's assets, liabilities, and equity. The income statement and the cash flow statement summarize activity over a period of time. And then a subsequent balance sheet will show you how operations impact assets, liabilities, and equity. And we're going to dive into each one in more detail now. So the balance sheet, it shows the co-op's overall financial condition at that one point in time. And we call it a balance sheet because there's an equation that needs to be in balance. Assets need to equal liabilities plus equity. There's a resource on reading balance sheets that we'll send in the follow-up email today that describes it this way in very plain terms, which is, as a co-op, we have a bunch of stuff, which is our assets. We owe money for some of it. Those are our liabilities. And the rest came from money the members paid, plus money that the co-op earned, which is the equity. Both the assets and liabilities have current and long-term kind of lines. Current assets are things that can be easily converted to cash and used within a short period of time. We usually say a year. So this includes things like your accounts receivable, actual cash on hand, and inventory that you have. Long-term assets cannot be easily converted into cash. So this might be a building, a large piece of equipment, or land. And with the exception of land, most long-term fixed assets lose value over time as they age. And the loss of that value is something that we call depreciation. And this needs to be accounted for in reports. The liabilities, those various existing obligations. The current liabilities are things due within the year. So this would include things in accounts payable, payment on loans for that year, and other accrued expenses. Long-term liabilities might be the balance on loans, mortgages, things that are due out beyond equity section shows the resources that the co-op has, both from member equity contributions and retained earnings. And it's a picture of what is available for future capital investment, distribution to owners. And it's also a cushion for the co-op to weather downturns, losses, potential issues with cash flow. And again, the balance sheet is painting a good picture if you see that the assets equal liabilities plus equity. An income statement, we sometimes also call this a profit and loss statement or an operating statement. This is the statement that people are often it's easiest for people to wrap their heads around. It has a section where, revenue, different ways the money's coming in, and various sections for expenses where the money's going out. When you prepare an annual budget, it will, the format of it, the categories in that are going to pretty closely match the categories in a income or profit and loss statement. The picture that it tells is that it ties revenue activity in a period of time to the expenses that you needed to generate the revenue. So the reporting on this is on an accrual basis, which means that the actual cash might not have been received or spent yet. And this is important and why we look at a cash flow statement, but the commitment has occurred. When you look at revenue and its associated expenses together, it'll allow you to see whether the revenue is actually covering your expenses and whether operations are profitable. That cost of goods sold section is like in a producer-owned marketing co-op. That's what the co-op has to pay the producers for the product that it turns around and sells. Expenses, they'll be both variable and fixed expenses. Variable things, fluctuate by sales volume. Things maybe like packaging and shipping. Sometimes, and labor can be variable. There might be some labor which is fixed. And so these fixed costs kind of have to be paid regardless of sales volume. Things like rent, utilities, interest on loans. So there'll be a profit before taxes. And if that's a negative number, the co-op has lost money on operations. If it's positive, the co-op has made a profit. And again, then you decide what to do with that profit and then how taxes are paid is related to that decision. A cash flow statement, it complements the income statement. It reflects actual flow of cash to the activities reported in the income statement during the period, and it actually reflects timing and other differences. As a result of this, the amount of cash at the end of a reporting period will most likely be different from the net income that is reported on their income statement. Most times cash doesn't change hands instantaneously, and so a cash flow statement will reflect delays in receiving payments from the outside, some delays, and maybe payments that you make. So another thing to note about the cash statement that is it's completely possible, sorry, to have a business that turns a profit over the course of a time period, like a year, but that struggles with cash flow at one or more times during that year. We often see this in businesses that have significant seasonality. And as a director, you should look for and ask about cash on hand so that you know the co-op can cover regular and recurring expenses like paying employees. There are absolutely strategies to handle cash flow challenges. You can have lines of credit. Some co-ops elect to defer some portions of payment to members. Not ideal, but it happens. This can be a place where you dip in equity if you know the cash is coming back to you. But you need to know in advance that there'll be this cash flow issue to have a strategy to address it. Knowing what your cash position is also helps you maintain inventory. You don't want to be in a position where you don't have cash to keep purchasing inventory to sell. And again, then you see that next balance sheet with its assets, liabilities, and equity. And the values there will have changed, some based on what happened over that month or quarter in the income statement and the statement of cash flows. It can also be really valuable to compare income statements. This usually happens at the end of the year, but it can happen with other intervals. This slide uses made up numbers. You can see that this co-op increased sales but kept expenses down. So while last year it wasn't profitable based on that net income number, and then this year it is profitable. You can compare an income statement to your budget, and you can also compare it to a previous year's income statement. And all of this gives you some information about how the co-op is doing. This annual audit that we mentioned, it's basically a fancy way of saying somebody's going to check the work, the accounting work that's been going on all year. If you get a third party audit, there'll be a full audit report that will have 2 years of consolidated financial statements in one report. And it will also include statements about changes in member equity. Auditors will include notes in the statements, and it's really important to read the notes. That can be where those notes can be things that generate key questions, and also can be where you see that highlight issues that might require some sort of policy or procedure change. And again, if you're a smaller, newer co-op that's not getting this external audit, there are absolutely ways you can do an internal review just to be checking the work. So financial statements are generated by humans and thus are not perfect, right? There can be problems with them. I will say, particularly for smaller or startup co-ops that don't have a lot of staff, keeping up with the bookkeeping and reconciling of accounts can be really. But financial reports are only accurate if that bookkeeping is up to date. And so that really is a priority. There can be things that happen that you kind of have to maybe allow for, right? Problems with inventory, the financial statements, you're not getting all of them they're not presented in a clear way. You have things in accounts receivable that aren't getting paid. I know friends with businesses right now who, because of coronavirus, are being told we can't pay that invoice. And so knowing that there can be issues, and then and that there needs to be open discussion about them at the board meeting. Okay, so I'll take a deep breath. You've made it through, let's say you've made it through a year of reviewing and approving financial statements, and your co-op generated a profit. This chart comes from our Co-ops in Wisconsin resource that can be found on our webpage. And it's an overview of how profit can be distributed, and also who pays taxes on which portion of the profits. This is where we remind people co-ops are taxed differently than regular corporations. This decision on how to allocate profits is a really important decision made by the board on an annual basis. And you kind of have to balance long-term financial stability and desires for growth with what individual members need or are expecting. So we have a scenario. We'll put some numbers to this. It's important to show here that this dividends to preferred shareholders, those are people who have purchased preferred stock, going back to our vocabulary. And then these two forms of unallocated and allocated profits. This pretty simplified example, this co-op with 5 members that do this amount of business with the co-op. This could be based on hours worked or products sold. That in this particular example, they cover their expenses, and there's a net profit of $1,000. Hooray. This is where we can see how profits are distributed to members on the basis of their use of the co-op or their interaction with the co-op. In this particular example, we're going to say there's no preferred stock, and the board decides that $500 of that net profit is not going to be allocated. And then half of it they will allocate to members. And remember, profit that gets allocated can have 2 parts to it. A part that's paid out in cash or dividend, and maybe some part that's allocated to members. In this case, $200 gets paid out in cash to the members, $300 goes on their equity accounts. Based on the member kind of percentage of business with the co-op, you can see those percentages. This is what the actual kind of cash payout and equity is for each member. This is where it's important to note that members pay taxes on the profit allocated to them. That's taxes both on the actual cash and on equity that stays on the co-op's books but in their name. Going back, the co-op is paying tax on that unallocated profit. Just an example of how this is the equitable way to distribute profits based on how members interact with the co-op. So we've talked about financial reports, about profit. So how do you kind of analyze the numbers, and what questions come from them? We're going to talk about these terms, liquidity, solvency, these involve some ratios that you can numbers that you pull from the various financial statements. And based on the sector that you're in, or maybe the type of co-op that you are, there might be kind of standards for these different. These are things you can inquire about with other co-ops in your sector, or do some research about. So liquidity, these are numbers that come from the balance sheet. Again, there may be a benchmark that's kind of specific to your sector, but successful co-ops often have a ratio value that's 1 to greater than 1.2. So you'll look at what are all the current assets, right? That value of what the co-op owns, and divide it by your liabilities. And again, pull these numbers off the balance sheet. This is the working capital ratio. Net working capital is assets minus liabilities. And so again, this will generate a number that, so what, but this is a number where you can try to benchmark yourself against other businesses or co-ops in your sector. Profitability looks at numbers in terms of a percentage of sales. And it's a way to understand how profitable the co-op is. So it looks at net income divided by sales. You can also, expressing things as you to compare these percentages between years or against your budget so that you can understand changes in the co-op's performance. So again, looking at, these are made up numbers, but looking, for example, in last year, this co-op lost money. This year, it increased both sales and decreased its cost of goods as a percentage of those sales. So you see, and so there were more dollars to cover other expenses. Some of these expenses increased. You'll see like wages, but you'll see that as a percentage of sales, they were lower. And you'll see as the co-op realized a net income after taxes that was 4% of sales revenue. So again, comparing, sometimes it's hard to compare raw numbers, but being able to compare these percentages helps you know both profitability and how efficient and other things your co-op is being. Solvency is another ratio to keep in mind. Again, these numbers come from the balance sheet. It's a measure of leverage or how much debt you have. Questions you might ask here: can the co-op pay off its debts if it was sold tomorrow? What would the ownership position be? Again, the numbers here, the number that for this ratio will vary by industry, but you want it to be around 40 to 50% for a healthy business. So again, in thinking about the questions you need to be asking as a board member and the planning you will be required to do as a board, understanding cash, how it plays a role in your business, where it comes from, where you have issues with cash flow, how it figures into recurring, to paying down debt, paying patronage. In really uncertain times, conserving cash can be really important. And in the follow-up email to today, we'll have links to some additional webinars that specifically talk about managing cash flow in the time of coronavirus. In your financial planning, you'll have to be thinking about equity, right? How much equity do you need on your books? How much of a cushion do you need? What is your co-op's feeling about debt, and how much debt you have versus how much that you raise, not raise, but how much debt you take on from financial institutions versus how much equity you raise to meet your needs from members and other sources. So that's a lot, but a few examples of how the various financial reports, how some of those ratios can help with board decision making. If you need to purchase something big or expand, all of those reports will play into that decision. How much of you want to be equity? How much do you feel comfortable with debt? A lot of smaller co-ops use grants in various ways. Grants for special projects or to help with certain startup activities. It's, grants give you cash, but it's really important to understand how the grant fits in the overall financial picture of the co-op, so that you don't become dependent on grants for your operation. And again, like there are always unforeseen events. And so these ratios give you a sense of where you are, what you have the ability to withstand, and then where you can most easily make changes to handle unforeseen events like coronavirus. Right now are thinking about very conservatively managing cash and other assets with so much uncertainty. Again, we talked about, financial statements aren't always perfect. You might be in a situation where a GM is not providing good reports to the board. This is a situation that can be very challenging. And also, it's something when you start getting going is a place to think about how do you build that into the job description and evaluation of the general manager's performance, so that it's just a regular expectation and part of the dynamic that you're getting that information. Another big question that how you communicate this financial situation to your membership. Again, you may be you're definitely doing this at least on an annual basis, particularly in times of uncertainty. It may be good to be communicating more financial information on a more regular basis, so that members are not concerned, or maybe they're still concerned, but they have an understanding of what the kinds of decisions the board is trying to make and what information they're using to make those decisions. So that was a very rapid, high-level overview of co-op finance. And now I think Courtney is going to address some of the questions that came in from the chat box.
All right, Drew. letting me unmute myself.
I hear you.
Oh, you can hear me? Okay, great. So if you have questions, please go ahead and enter them in the Q&A box. There haven't been any that have come in. So Kelly, I might have you. I know there were some questions that came in from during registration. So if
Yeah.
you maybe take one of those, and if you do have questions that came up in the presentation, please type them now in the Q&A box.
So one of the questions from registration is, what are some strategies that to have an impact on co-op finances while still practicing policy governance? What I think about in answering this question is the role of the board in approving a budget, right? So that this might be a high level budget, and depending on the scope of your co-op, each line in that high level budget might have sub budgets that staff and others are working out. But that's that. And then that they'll probably, ideally, you have some policies around, deviations from the budget, large expenses that staff might make and when they need approval from the board. But that budget approval is really a way to delegate to a manager and the rest of the staff what they can do in the scope of the business. Do you have any other thoughts on that?
No, I don't, but a question came in from Steve. Hi, Steve. His question is, does unallocated profit or unallocated equity become the indivisible fund? And so just to unpack that a little bit, often that term indivisible fund is used, I've seen it used mostly in worker co-ops, but to describe a fund that is not attributed, in which none of the equity is attributed to a particular member. And it can be used, there's different sort of reasons that people set those up. And so to answer your question sort of in two parts, one, unallocated profit or unallocated equity is not tied to a member's name. However, depending on how the rules are set up in the cooperative, if the cooperative were to dissolve or sell out or be merged or something, depending on how that process is set up and what the rules are, that unallocated equity might be distributed to members based on some equation, just because the members own the cooperative, and so that profit might be distributed at that point, or equity might be distributed to members at that point. There are some cases where there are rules written about that sort of protected indivisible fund. And one of the reasons that co-op might establish that is to really disincentivize demutualization. So demutualization and just means dissolving the cooperative and making it no longer a cooperative. So it could mean, it's actually not dissolving, it's turning a cooperative into a non-cooperative business. And so sometimes co-ops will use different rules and structures to disincentivize the members from demutualizing. So I'm not sure if that answers your question, because there's sort of two different things there. But often indivisible funds are the money that goes into the indivisible fund is from unallocated profit, or profit that wasn't or surplus that was not generated through the work of the owners, but it doesn't have to be funded through unallocated. It doesn't have to be exactly set up that way. See if there's any more questions.
So there was another question from registration about what tools are there to facilitate a budgeting process and the best format to insert in a business plan. So a couple things. When startup development, preparing study or business plan, you will create your pro forma will be statements that look like a balance sheet, look like cash flow, and look like profit and loss statement, but they are all hypothetical. They are educated best guesses, but they're not what's actually occurred. They are what you think and hope will occur. So you want them to contain, as best you know, the lines. You want them to look like those reports would look in the actual business in terms of a format. There's also might be an additional document in startup that's called a sources and uses budget, and that we didn't discuss that today. That captures some different information, but that's particularly if you need a lot of you need like a grocery co-op needs a building, an inventory, a sources and uses budget. In a lot of ways, it will. Anyways, we can provide resources for that. To facilitate budgeting is something that takes experience, right? If you're a director in a long-standing co-op, there may be a really established budgeting process. You can certainly, ask questions about that process. Get on the committee that helps develop that budget. I would say the budget, it usually looks like the profit and loss statement. And I think in terms of the categories that it includes, yeah, I mean, sometimes in startup, it can feel like the minute you put the budget on paper, it's instantly not accurate. But it's also the conversations that happen around budget development are very valuable for understanding the operational picture and the decisions that the board might need to be making. And we can certainly work with folks offline more about how they might approach a budgeting process. Anything specific tools you have worked with, Courtney? Budgeting processes?
No, I would just say that I think it's one of those things that you get better at as you do it and you learn, and it's a tool for measuring against what your expectations were. So even if you're way off, if you're really wrong, at least you're measuring against something. There's another question in the question box, and I do want to just add one thing to my answer to Steve that occurred to me that was a more helpful clarification. But if you're in a cooperative where, a worker cooperative in particular, where all of the workers are members and you're not probably not really generating surplus or profit that isn't attributed to a member's labor, you might have a rule in that cooperative where 5% of surplus automatically goes into that unallocated fund or that indivisible fund. And so there can be, when I referred to there being sort of rules perhaps about how you fund something like that, sometimes that is written into a policy, or the board just decides on an annual basis, this is how much we're allocating to that indivisible reserve. So the other question that came in is from Jan. Hi, Jan. Monthly finance reports to the board may be difficult for smaller co-ops using software like QuickBooks. Is quarterly information, for example, when inventory happens, acceptable? I would say, I'll just say one thing, and then Kelly, I'd love to hear your thoughts on this question, is that there are probably times in the life of a co-op where quarterly information is totally fine. And there are times when you then as a board may say, whoa, something's going on. The trend line has shifted. There's a major event like the one we're in right now, where you say as a board, in order to really do our due diligence here, we need to see financial information more regularly. There may be certain metrics that you want to track more frequently. A full set of financial statements may not be necessary, but are there a handful of metrics that you feel it's important to monitor? I think it depends a bit on the business as well, but yeah, I think there are cases when receiving certain reports, in particularly like balance sheets and things quarterly, is very appropriate. But Kelly, thoughts on that, having worked with some very small co-ops that I'm sure face this same challenge?
Yeah, I think both that there's the time involved in generating them, and that it can feel, if reviewing financial reports is new to most people, it can feel like a portion of the board meeting that also takes up a huge amount of time, and there's so much to get done. And I think that there's often these competing time interests in startup because there's so much to do. So I think I would say I wouldn't skip it entirely. As Courtney said, I'd say, what are a few numbers that we can at least check in on at those more frequent board meetings, and then the full statements maybe a little less often. And again, based on something that's going on, right now, I know if you're really worried about cash flow, maybe you make sure you can get that cash flow statement, or you're really worried about sales and in relation to expenses, you get that number, and I think that also, the size and complexity of the business, a lot of those numbers will have their own sub spreadsheets and things attached to them that also don't have to be reviewed often. But I would encourage you to not. I would encourage you to consider some amount of financial review critical always. I think it's easy to say, well, we didn't look, it's easy to get in the habit of looking at it less and less often, especially when it's the thing that people are least motivated or, to do or have the least comfort with. And so I think the more you can establish it as like a thing that is just part of what the board always does, the better.
So I think we have time for one more question, and there's one from Robert, and I asked him to unpack it a bit, but I'm going to ask it anyway. So he said, you keep mentioning budgets, and I think his question is, are you only talking about like a profit and loss statement type budget, or also cash flow? Sort of like maybe like how complex is that budget? We talk about these different financial statements. How do you build those into the budget, or what role do those different statements play in the budget that you're creating? I think I'm interpreting your question correctly, Robert, but let me know if I'm wrong.
And I would say, I'm working with a co-op right now that is just adopted their first annual budget, which is very exciting. And I highly encourage them to also do what I called a monthly budget, but essentially was a cash flow budget. So that, because they're trying to make a decision about hiring staff. And they have some big sales projections for the year, but it's like, okay, what do the kind of ongoing sales need to be to cover wages for someone that you hire? And so, yeah, I think, maybe the co-op board only approves like a big annual budget. I think the life stage of the co-op and things it's about to pursue may dictate the level of detail that you budget on. And sometimes some of that level of really detailed budgeting stays at the staff level as long as the overall budget is approved by the board. Anything to add, Courtney?
No, I sounds right to me. All right, well, it is 10:29, so thank you, Kelly, so much for your presentation. And do you want to close us out here?
Yeah, so just as we've noted on the previous two webinars, this is our co-op development team at the center. We all specialize a little bit based on type of co-op and sector. So feel free to reach out to any one of us, or the person, and we can direct you to the right person, or the person that you think is the best fit for your co-op business.
Awesome. Thank you, Kelly, and thank you to all of you for joining. You will receive a thank you email shortly, and it will include a link to an evaluation. We really encourage you to complete that evaluation. If you have ideas for topics you'd like to see covered in future webinars, please share them. I suspect we might be delivering content in this format for the foreseeable future. So we're happy to cover other topics and expand this series based on your interests. So the recording will be available on our website in the next day or two. And this concludes our series on Director Responsibilities 101. So thanks so much for being here, and take good care.